Reversal chart patterns in technical analysis are graphic figures that create an inversion of the current trend. To trade reversal patterns, it is therefore necessary that there is a reference trend to be reversed. The importance of these type of patterns varies according to their size and duration. The longer the time of their formation, the greater the probability of a trend reversal. The main reversal patterns are the double top, the double bottom, the triple top, the triple bottom, the head and shoulders, and the inverse head and shoulders. If the reversal pattern is not confirmed by price action, and does not follow strictly the rules, we could therefore have a strong signal of continuation of the trend. Enter the market only when the pattern is complete and price action confirms the new direction. Never anticipate its formation, but instead trade what you see. The reversal patterns formed near important support and resistance levels will give a greater chance of success. The double top, also known as double confirmation of resistance, can be found at the end of an uptrend, and it is an excellent signal of a bearish reversal. It consists of two highs, the second should be slightly lower than the first. The greater the time frame of the pattern, and the greater the probability of success of the trade. The double bottom, also known as double confirmation of support, can be found at the end of a downtrend, and it is an excellent signal of a bullish reversal. It consists of two lows, the second should be slightly higher than the first. The greater the time frame of the pattern, and the greater the probability of success of the trade. The triple top has exactly the same rules as the double top pattern, but before we have the actual reversal of the trend, we need a third confirmation bounce of resistance. The triple bottom has exactly the same rules as the double bottom, but before we have the actual reversal of the trend, we need a third confirmation bounce of support. The head and shoulders pattern is a classic bearish formation that is identified at the end of an uptrend. The pattern is formed by a first higher high, which will be the left shoulder, then a second higher high, also known as the head, which will be the highest point of the pattern, and finally price will create a lower high, also known as the right shoulder, that will be lower than the head and the left shoulder. The inverse head and shoulders pattern is a classic bullish formation that is identified at the end of a downtrend. The pattern is formed by a first lower low, which will be the left shoulder, then a second lower low, also known as the head, which will be the lowest point of the pattern, and finally price will create a higher low, also known as the right shoulder, that will be higher than the head and the left shoulder. Once we identify one of the patterns, it is important to identify realistic targets. This means calculating where to place the take profit and stop loss correctly. To determine the take profit, simply measure 70% of the total pips of the length of the pattern, and double it in the direction of the new trend. 70% is a good target, because price moves in waves and there could be some short-term retests of the breakout. However, price can also reach 100% of the total length of the figure. The stop loss will always be positioned above or below of the pattern that has been created, depending obviously by the trend direction.